Presented by eBix Cash. हर खुशी के लिए काफी है.
Hello and welcome to this market special from Business Today. I'm Udayan Mukherjee, with me is Abha Bakaya, and our guest today on the show, an old-timer from Dalal Street, Ashwini Agarwal, partner of Ashmore Investments. Ashwini, it's great to see you again, and it's been such a remarkable market in many ways. I mean, it gives you this feeling periodically that a big correction is finally beginning to start, but it just takes a few knocks and it's never more than a 5% dip, and it just continues to move ahead. Do you think we can roll on like this for much longer, like just consolidate periodically and move higher and higher, or do you think one of these corrections will turn out to be the real one?
So then, good to see you again. Great question. I was just tabulating. It's the longest increase or uprise in the market, or a rising trend in the market without a meaningful correction. It's almost 18 months old. From the lows that we saw in March 2020, we saw, a correction, whether you can call it meaningful or not is debatable, but we saw a correction, let's say from the 30th of April 2020 through till 17th or 18th of May 2020. But since then, and it's 18 months, almost 17 months, we haven't seen even a single double-digit correction. And since 1992, I don't think we've seen a single uptrend which is so long and so powerful with no pullback. So obviously, it feels that the party can go on forever and there's nothing wrong. And to be certain, the top-down news in India is actually quite energizing and quite positive. But as you mentioned, I'm an old-timer, and when I look back at the trend that I've seen through 30 years of investing, it just seems unreal. And I think that there should be a correction. There will be a correction. When and how much, I don't know. But are things lining up to expect a correction? I think so. I think there are factors that are starting to worry me. So just to name a few, very early in my career, I was taught by a market veteran that markets are all about demand and supply, just like any other market. It's demand and supply for paper. And we've seen $9 billion of new IPOs already this year. We've probably got another $2.5 billion being raised in short order over the next 3.5 weeks. And every successful IPO, in my view, is encouraging more such offerings to come through. In terms of demand, if you look at the foreign flows, there is no incremental net new investment coming through for a couple of months now. Even the participation in IPOs is being funded from sales of existing positions, as it would seem. Local mutual funds are definitely seeing a huge amount of inflow from investors, but how much of that is coming into the market is a question mark, because the net purchase figures from mutual funds have also been fairly soft. So I think, the demand-supply equation is starting to get a little worrying, at least, the way I look at it. Second is that the earnings season so far isn't giving you a positive momentum to earnings revisions. So when P's are already high, you need earnings revisions to hold the market up. And that hasn't come through. Banks, of course, you're probably going to see some positive momentum and some positive revisions. Tech, a little bit, but outside of that, there's really nothing. So, if you think about it in terms of demand and supply, a correction looks potentially possible. And in terms of earnings momentum and valuations, a correction looks possible. We'll have to see how and when it pans out and what's the event that triggers it. But these are the fundamental factors, in my view, and the technical factors, in my view, that one has to think about.
Right. It's interesting that you mentioned one technical factor, demand supply, and one core fundamental issue, which is earnings. But as you well know, that sometimes these factors by themselves, while they may portend a correction, they may not precipitate one quite as soon as you imagine it may come about. Sometimes it needs a different kind of a pin to prick the bubble. So my next question is, what do you think is that event which can then bring these fundamental and technical factors to bear on the correction that you are suggesting?
Udayan, having seen several of these events over the last 28, 30 years, the event which will precipitate the correction will be known only in hindsight. We will not know what caused it. We will not be able to see it coming. We can guess what this might be. It might be increase in interest rates. It might be inflation prints. It might be energy costs. It might be foreigners suddenly turning panicky. Who knows? It might be a corporate blow up of some kind that we can't imagine today. But usually, the truck that rams into this bus is not visible. It's usually coming around a corner and you don't see it till it's upon you. That's the reality of markets. So, the way I think about it is that yes, the momentum is strong today and everybody is looking to buy. And, you could argue that the top-down picture in India is looking extremely interesting and energizing. But I think the fundamental and the technical factors are starting to point in the other direction. Now, how long does the rally continue? Will you see another 10% up on the Nifty before, I'm right, or I'll be laughed out of the room because the Nifty will be 30% from here? I don't know. I can't predict these things. But what I can tell you is that India is more expensive today on historical PE basis than it was back in 2000, which is the most expensive I have ever seen. Unfortunately, fortunately, I was not around when the Harshad Mehta boom took place in early 1992. I joined the business in June 1992. But, in my memory, I have not seen valuations at these levels. With valuations at these levels, rates looking to go up, inflation being on the higher side, earnings momentum slowing down, I can't for the life of me see what will allow the party to continue. Yes, more and more retail participants can continue to come in, more and more money can continue to flow in. In the short term, I may be wrong, but that's fine. We've seen this before. So I think, if we recognize the different ingredients that go into the mix, several of them are pointing in a not so positive direction. The top-down story is very energizing. I mean, the government's doing the right things. The policy noise is absolutely great. There are no macro imbalances in the economic system, unlike in 2013 or, back in 2000 or 2001 or 1999, where the fundamentals were in face of very, very challenging macro economic backdrop. This time around, that's not the case. So I think the macro story is very interesting. You'll probably see real GDP growth accelerate from here for the next 2 or 3 years. But I think the market's been quick to discount what's up ahead in terms of the fundamental story, which is why I worry.
Right. So, most people are cognizant of the risk of a correction at this point in time. It comes up in conversations and the market keeps chugging along and people say, okay, we'll play along for the moment. But as an investor, how do you prepare for the event of a correction like this when the market's not given you one for 18 months? I mean, do you move something to cash? Do you tailor your portfolio into even higher quality so that the knock that you experience on your portfolio is not that damaging? I mean, what's the right tactical way of allocating money at this point in time?
So there are different portfolios that we manage, right? So some of these are institutional mandates, which are by definition long-only mandates and have caps on the amount of cash we can hold. Because obviously the client is giving us their equity exposure and they don't want us to take cash calls and feed through to a lopsided asset allocation at their end. In such kind of portfolios, what you do is you probably move into areas where you see some protection. For example, utilities. Of course, power companies have not been behaving like utilities in the last month and a half. That's a different story. But typically, you move into some yield-oriented stocks or some defensives where you hope that the punishment will be less severe on the way down. You also kind of take money off the table where you feel that the valuations are excessive and move into, as you mentioned, higher quality, reasonable growth, reasonable certainty type environments where, again, you hopefully will outperform if the market falls off. And third, you look for bottom-up ideas. I mean, India is always about bottom-up, and it's interesting that even in an expensive market like this, we continue to find ideas that look good to us from a 2 to 3 year perspective. Financials is one area where we've been extremely positive for the last year and a half. We've had a hard time holding on to value stocks here, but finally, I think this investment should pay off. So that's another area where we are starting to find some traction. So it's a bit of all what you say. It's a bit of cash, it's a bit of defensive, it's a bit of quality, and it's a bit of bottom up. That's what you do for a long only portfolio. For an absolute return portfolio, I think the answers are slightly different. You move significantly into cash. That's what I would do. As an individual investor, I would recommend to your viewers that please review your asset allocation. This is a great time to take it back to where it should be, because if you started out with, let's say, a 40% equity exposure in middle of 2020, you're probably at 70 or 75% now, and it's a great time to take it back to 40%. Even consider moving down a notch. I always tell people that your asset allocation should be in a band. Let's say you're my age, 55 years, and you want to have, let's say, 50% equity exposure. You can move in a range of 40 to 60, and this is the time I would be at a 40 and not at a 60. And maybe middle of 2020 is the time when you should have been at a 60 rather than a 40. So you play around with that. So I think this is a great time to be going at the lower end of your tolerance in terms of equity exposure and building up some cash if you're looking at an absolute return portfolio.
Okay, so that helps us strategize. Ashwini, tell us, where are you finding the pockets of opportunity? You've been fully invested. You've definitely been seeing the potential in this market. Which are the sectors? You talked a little bit about defensives, about real estate through proxy plays. Talk to us what's top of mind for you right now.
So, Aisha, I mentioned financials. So that's one which I'm very positive on. I think, banks and lenders will do very well. And that stems from my earlier comment that I'm very positive on India's economic outlook. So loan growth, which has been under a huge pressure for the last 2.5 years in particular, and banks which have faced the penalty for having lent to a lot of infrastructure companies that didn't do so well, and real estate, say 10 or 12 years ago, they have finally provided for a lot of those assets. So I think, in a nutshell, financials will see three drivers. You will see top line growth because your balance sheet expands. You will see net interest income grow ahead of asset growth because interest rates are going up. You will see cost to income fall because there's an operating leverage that's embedded in the balance sheets. And then finally, you will see credit costs come down. So earnings growth for financials is going to be extremely strong, especially the banks that have a good retail franchise on the liability side. So that's one area where I think I can unequivocally say that there is value in this market. In the traditional sectors, I still feel reasonably positive about pharmaceuticals. I think there's a huge skill set that India has developed. I think there's a huge compliance culture that has finally been learned over the last decade and a half. And I think it's a very important skill, and we have that skill. And I think, you are seeing some headwinds now in terms of earnings because several raw materials are in short supply and transportation costs are high. But these are cyclical factors in my view. Structurally, this is an area which is still very promising for me. And finally, bottom up, I would say domestic industrials, because I see the investment cycle picking up. Whether it's machinery makers or, some builders or some contractors. It's a wide variety of companies and stocks out there which look interesting to me. Because I do expect that there will be a pickup in industrial investment in India. And I think some of that upside is still to be captured into several stocks. Last but not the least, I think exporters. If you look at traditional exporters in food, in textiles, I mean textiles sort of had a flash of a flavor over the last month and a half, but it's pretty much an ignored business. And I think there's a huge potential out there. I mean, this is an area where India has traditionally had a lot of strength. We lost our way because I think we became very investment heavy through I think very, very attractive financing schemes that were offered by the government, which led to misallocation of capital. But I think finally we seem to be moving in the right direction. So textile exports look good, food exports looks good to me. Essentially the China plus one narrative in many areas, that is where some opportunities will arise. But this will be a lot of bottom-up stock picking. I don't think this is very sector specific.
What about the value end of the market, Ashwini? Because, the last month, as you briefly alluded to, I mean, they've been moving like rockets. Some of these traditional utilities, I mean, the NTPCs, Coal Indias, and even the ignored ITC moved up 40, 50 bucks. I mean, do you see this kind of momentum continuing in that end of the market?
So then no, utilities is a space, especially coal-fired utilities. I worry about them because I think climate change and ESG concerns for institutional investors are here to stay. I see the debate, which is that a poor country like India should continue to be able to burn coal and provide the electricity to its businesses and to its consumers. We are still very early in the cycle of development to be able to afford alternative energy. But I think climate change is upon us. I mean, what you've seen in Uttarakhand last week is not pleasant. And we've seen unseasonal rains, floods with increasing frequency. I mean, whether a country is poor or rich, it doesn't matter. We do need to take cognizance of climate change, and it's upon us. So unfortunately, coal-fired energy is not something that excites me. So some of these value pockets that you spoke about, to my mind, are not something that we would invest in. But partly these are ESG related as well, rather than a pure value or a bottom-up investment. I think there are ESG concerns that hold me back in some of these instances, without taking specific stock names.
Well, you were speaking about earnings and financials just a while back, and ICICI Bank has got such a great response from the market after its earnings. But conversely, the other pocket, which you would presumably own, because all large investors own a slice of the IT sector, that did not get a great response after the TCS results. Would you worry about that front, the traditional software services companies, or do you think if a correction were to come about, you would seek refuge in some of these really strong balance sheet, strong management kind of companies?
It's not a very straightforward answer, but let me try and share at least how I think about it, right? IT services has been doing very well for the last 15 or 18 months in terms of stock price performance. If you look at several stocks, they are trading at valuations we haven't seen for the last nearly 20 years. For sure, Infosys was more expensive back in 2000 or 99, but since that point, we've never seen IT stocks trade at the valuation that they're trading at. Some of the mid caps are trading, at 60 times 12-month forward earnings. IT services business are seeing a great tailwind right now. Everybody needs to be mobile, be able to access data and applications on the cloud, whether you're a company and it's your internal users, or if you're a customer-facing business, it's your customers. So, and that migration was suddenly forced upon everyone by COVID. So, suddenly everybody's seeing more business than they could handle. So these valuations have shot up. Now, as a value investor, my suspicion is that the valuations are excessive in the IT services space, and I wouldn't want to necessarily be significantly overweight the IT services sector. But as you mentioned, this is also an area which has very high quality attributes, conversion of EBITDA into cash. Generally speaking, these companies are very well run. They have very high levels of governance. The balance sheets are squeaky clean for obvious reasons. So many of them offer very attractive dividend yields relative to other stocks that we have in India. So in a down leg, I would argue that the large cap IT would probably be a store of value. I'm not so sure about the smaller companies because valuations are a little more challenging there. But I think the large cap IT would definitely be a store of value in a down leg. They would probably outperform a sell-off in the market.
Okay, let me toss a difficult question at you because it's almost impossible to answer. The nature of the correction that we have discussed in this show. If you had to guess, and it can only be a guess, what do you expect to see in the term of the texture of the correction? I mean, it could be a short, sharp, brutal 15-20% kind of fall, rattling investors, but then the markets might quickly find their feet once again and continue to rally on. Or it could be the correction that we saw post 2017-18, where mid caps went into a hole for a couple of years and most portfolios underperformed the Nifty. And it took time to work its way for the market out of that hole. If you had to guess, which one of the two are we going to be closer to?
I think, like you said, it's a guess, right? I'm no soothsayer, so I think it would be the first, not the second. And the reason I say it is this. 2018 to 2020 middle or 2020 late was a very challenging time for India. We were still experiencing the aftershocks of demonetization and introduction of GST. GST introduction was, very challenging for a lot of players. It was very difficult to adapt to, at least in the initial phases. And immediately in 2018, you were presented with a sort of a mini crisis in the financial world with the collapse of ILFS, which was closely followed by the bankruptcy of Diwan Housing and Yes Bank. So, what happened was multiple factors. So you had, reasonably scared investors because, you had accidents going on, you had no earnings growth. And by the time you started getting your head wrapped around all these challenges and started to come out of it, which was towards the end of 2019, you were presented with a pandemic like COVID. So these are events which are very large tectonic shifts in how you look at history in market cycles, right? They're very, very large events, and very large events compressed in a fairly short time cycle of 4 or 5 years. I mean, these are all kind of events that we'll probably talk about 10 or 15 years from now. These are not some things that we can forget. My sense is, as I mentioned, that the policy direction, the policy narrative is very positive. My sense is there are no dangers in bank balance sheets. The financial system is quite strong after all the cleanup and the dusting and the polishing that has happened over the last 10 or 15 years. My sense is that there is a strong underlying demand that is there in the economy, which will come back, assuming there is no significant third wave, which is the base case we are working with at this point. If you take all of these, then I think the core economic outlook is not impaired, is not damaged. There is risk of inflation and rates. That's something that we'll have to work through. A moderate inflation and some increase in interest rates is possibly not bad. It can lend to better nominal growth and better earnings growth. Interest rates and inflation tend to be destabilizing only when CPI goes into the double digits and starts to hurt demand in a significant way. I don't see that happening, or at least I hope that doesn't happen in the near future. So if I put all of this in a mix, what I'm really saying is that, look, we are in a very, very good place from a macroeconomic perspective. This is also the first time India is seeing good amounts of risk capital that can finance ideas, release productivity gains in the economic system that we haven't seen. It can help grow 1,000 new entrepreneurs. And something like this we haven't seen in our history, the abundance of risk capital. So on a macro basis, I'm very positive. I'm worried about the valuations being stretched, and in the short term, the earnings momentum slowing down quite significantly. So the event could be something outside of India, the event could be something within India. I can't predict that. But I do expect a short, sharp correction, and which will bring hopefully valuations down to a more reasonable level. And then, we start building in better fundamentals going ahead. That's how at least I think about it. But, then markets always surprise all of us. This may sound very logical and very nice and very easy to deal with, but I can tell you that I will not be able to guess what causes the market to go down and what kind of ripple effects it causes. If something large blows up, a large company blows up, or a large bank blows up, or something happens in the macroeconomic system that we don't know, all bets are off. Then you have to regroup and rethink. Let's go back to 2008, and 2008 is very instructive, right? 2008 we had no macroeconomic imbalances. You had very solid domestic demand. You had very solid, current account balances. Fiscal deficit was at decadal lows. There were no problems. Lehman happened. We had all the money in the world domestically to be able to ride out the Lehman problem. So you had a very strong bounce in 2009 and 2010. And what happened was that we took our eye off inflation, which led to a massive amount of imbalance in the system, because demand grew far faster than what the supply response could be, resulted in a massive amount of current account deficit and fiscal deficit, which culminated in the depreciation of the rupee in the middle of 2013. So I hope that we won't have the same level of macroeconomic imbalance building up, and that's my hope. But this is how I see the future going.
Fair enough, Ashwini. Great talking to you as always. Thank you very much for your time today. It was wonderful catching up on the markets again. That was our market guru for this week. We shall return next week as always with another voice of experience from the stock market. Till then.